Konnichiwa and Assalamu alaikum. It's been a rocky week in markets over the last fortnight, with the whole world having its attention turned on Dubai, and in particular what's happening with the Dubai government and one of its government-related entities, Dubai World. Just prior to the Eid break, the government of Dubai made two important announcements relating to credit markets and also equity markets domestically. The first announcement was a good one. The government said that it had secured $5 billion US in funding from two key Abu Dhabi banks, both owned by the Abu Dhabi government, with which to funnel into the Dubai Support Relief Fund, which can then channel the funds into Dubai governments of strategic importance that are required to refinance debt. The announcement should have been a positive for local credit markets, given that it improves the cash flow to government-related entities and also contractors owed money from these. However, the scheduled nature of the loan agreement really tells us that Abu Dhabi's lending to Dubai is coming with more and more strings attached. The second announcement, which was the most important, relates to the restructuring of government-related entity Dubai World and its subsidiary Nikhil and also Limitless. The first step involves Dubai World requesting a standstill on all of its debt related with these three companies, which on face value is worth $26 billion. They want to extend the debt to at least 30 May 2010. Some of the debt, around $3.5 billion US, was due to be paid on the 14th of December 2009. The total amount of debt the government is referring to is $26 billion US dollars. Now, the government of Dubai distanced itself from Dubai World and said that it will not act as a guarantor to Dubai World's creditors, as was previously stated in the prospectus for the various bonds associated with Dubai World. Now, Dubai World is approaching its creditors at present and working through ways to restructure the Nikhil bond and also the other bonds. The Dubai World proposes to restructure its companies in three key ways. Firstly, it's looking at selling down assets to release cash flow, and some of Dubai World's core assets include QE2, its stake in DP World. It has hotel and casino assets around the world, as well as property developments here in the UAE. Secondly, Dubai World aims to drive cost-cutting measures and improve profitability through a normal business strategy. And thirdly, there is a possibility that Dubai World will close some of its underperforming business units and write down the carrying value of these assets. UAE credit and equity markets reacted savagely to this news, with credit default swaps doubling from 2.3% to well over 5% on Dubai credit swaps, indicating the much tighter credit conditions and increasing risk premium credit providers need to factor into debt issuance in the region. UAE equity markets also declined by 8% and 6% respectively on Monday and Tuesday last week, with downside driven by forced sellers on margin and also irrational tendencies from some investors fearing the worst. Key index stocks Emaar, Arabtech, Eldar, Saru, DFM, Shua Capital and DIB, plus the Abu Dhabi banks were some of the worst affected, as investors digested the news and the problem that with $26 billion worth of loans from Dubai World being restructured, working out which banks may have to write down some of the carrying value of these assets, which would restrict their profitability next year. Major banks with exposure to Nikhil and or Dubai World include DIB, Abu Dhabi Commercial Bank, National Bank of Abu Dhabi, First Gulf Bank, Emirates NBD and also Mashreq Bank. To date, NBAD is the only UAE bank to state specifically what its exposure to Nikhil and Dubai World is, at $345 million US dollars. As the remaining UAE banks disclose their exposure to the companies in question, we believe that equity and credit markets will gain more confidence that this is not as big an issue as the international media is making out, and that it can be resolved through restructuring of the debt and also of the businesses involved, and potentially some asset write-downs, which is no different from what we've seen in Europe and the US over the last 2 years, where $2.3 trillion has been written down from the carrying value of assets.